What's going on, guys? Hope you're having an absolutely fantastic day. So since the October 13th bottom, the Nasdaq is up a staggering 6.3%, right? So just to give some context, obviously this is 6.3% in 5 days, right? And if we zoom out, obviously the Nasdaq is still down big on the year. But a lot of people have been asking the question, so is this a market bottom? How come the rebounds are so sharp and there's so much volatility, right? So today I'm going to try to answer that question as well as look at some data to help us answer that question, right? So I'm just going to start off with the home builder index, and you can see home builder sentiment drops to half of what it was 6 months ago. US home builder sentiments fall for 10 straight months, right? So why is home builder sentiment important towards the stock market, right? So housing is obviously very important to the stock market because housing's wealth effect correlation with people spending is very high, right? So basically, the higher your house value, the more you tend to spend, right? So you can remember that last year or the year before that, when housing prices were climbing like crazy, 20% a year or something like that, we can see that at that time, a lot of people were investing in their homes, right? Building new pools, maybe making their gardens nicer or decorating the houses or stuff like that. And it's considered an investment, right? But now you can see that when the house prices are going down, no one is doing all that. So things that they spend on like pools and all that, it will also help the economy, and maybe like they do decorations or renovations. It will also help companies like Home Depot and maybe all the housing related stocks, right? So now also a real estate sector is not doing so well. Obviously, the people who sell real estate and all of that are also not doing so well. The builders are also not doing so well. And basically a lot of jobs related to the home building industry is basically teetering down, right? So the second thing we have to look at is the University of Michigan survey, right? So basically this is to measure consumer sentiment, right? And why is consumer sentiment important? Obviously, if you are very confident about the job market, you are confident about the economy, you'll go out and spend more, right? So you can see that year over year, it's down 17.2%. So it's a huge decline, right? So basically saying that Americans are not so confident in the economy. And this is primarily driven by inflation, right? And this is also something that we'll talk about in more detail later, right? But basically, what this survey is saying is that consumers and Americans are basically spending less, right? Because they are less confident, right? But we also have some conflicting data, right? Because if we take a look at Bank of America and also JP Morgan and Chase CEO, they are both saying that the US economy is doing well and consumers are in good shape, right? The consumers basically have more money in their bank accounts by multiples than they did in the pre-pandemic, right? So one thing is to note that what these bank CEOs are saying, but another thing is to actually look at the data, right? And if we look at the data, consumers are not as confident. So credit card debt that I have showed in previous videos are not as high, and also consumer savings rate are going down the drain, right? So I don't know what these people are talking about when they say that consumers basically have more money than in their accounts than they did pre-pandemic, right? So maybe they are just talking their book because they have to keep their investors bullish. They have to keep the economy bullish. And obviously, if Jamie Dimon comes out and says, oh, the US is going to go into recession, right? What will happen? So just him saying that will lead to maybe potentially a small snowball, which may actually lead to a recession, right? Because if he comes out and says, oh, we're going to go into a recession or something, his banking clients might also start spending less, or things like that, right? Or bank less with them. So we have to realize that the economy is reflexive, right? And basically what reflexive means is that if the chairman or of the Federal Reserve or the president comes out and says we are in a recession, right? Basically, a lot of the people that are listening to them will also start to spend less, and basically it causes the recession, right? So because obviously if you come out and say it and then people spend less, so what actually caused the recession is the person saying it in the first place, right? Obviously there is some underlying fundamentals that cause them to say it in the first place, but they can exasperate the scenario, right? Basically if they come out and basically say that we are in a recession, stop spending so much or stuff like that, right? And that is basically what the Federal Reserve is trying to do, right? They are trying to talk markets, equity markets, and also the housing markets into going down, so they don't actually have to do what is necessary, right? Which is what is necessary now is like raising interest rates to a abnormally high rate, right? Which they cannot afford to do and they don't want to do, right? Because it will also like cause a huge decline in the economy, because American the American economy is debt-ridden, as well as everywhere else on the planet, right? So now we get to the next point, which is the earnings recession. Oh, but before that, let's talk about the treasury yield, right? So 10-year treasury currently sitting at 4%. So mortgage rates are around 7%. So we can start to see that why housing prices are dropping, right? Because people can no longer afford all these payments, right? In fact, I saw a chart by Charlie Belilio. Basically, he said that the same house price now costs about double or somewhere around there, right? So basically, if you're buying a $1 million home, let's say your payment was I don't know what the payment is, but let's say 10,000. Now it will be 20,000, right? So that is just to put into some context. The same thing that costs the same 1 million is now costing you double monthly payment, right? So I don't know whether I butchered that explanation or not, but let's move forward, right? So earnings, right? So let's talk about earnings. So recession warnings are hard to find in Wall Street bank earnings. So you can see articles like this from 1 day ago because the banks have come out and basically their earnings are still good, right? But what I have seen is that obviously maybe we have priced this in too early, right? Because we can see all the stock prices basically beforehand, somewhere around here. Let's look at 6 months, right? Somewhere around here, we are pricing in that we are going to have an earnings recession, right? And I think we are still going to have an earnings recession, except it'll be a bit later than we think, right? Because in this part, maybe people can still spend using their credit cards, taking on more debt and things like that, right? So that is what I firmly believe. And that is why I believe that this earnings is actually not going to be as bad as people think. But the next subsequent two earnings, I know it's pointless to make forecasts, but this is just some of my internal thoughts. I think that the next two earnings will be worse than people expect, right? Because this earnings is going to be good, and then everyone's going to be very cheery, and it's also a factor of whether the market rallies, right? So if the market stays here, flat lines, then maybe my bets wouldn't be so confident, right? But if the market rallies, I'm going to sell off some of my stocks and also options, which I've mentioned in the past videos already. So in order to raise some cash, because when the next leg comes, I want to be ready as well, right? So in my opinion, what's going to happen is this earnings is not going to be as bad as people think, and basically all the stocks will rally. So this is my short-term prediction, so take it with a grain of salt. And the next few earnings, right, I don't know which one it will be, might be the next one, or maybe the next two, or maybe even the next three, right, will be quite bad, because what will end up happening is consumers that have maxed out their credit cards, which I've been looking at a lot, and more people are taking on more and more debt, especially when the interest rates rise, right, so they can afford to take on less debt, right, will start to not spend so much, right? So they will actually have to tighten their belt. So currently, they are not tightening their belt. What they're doing is they're just spending, and they're taking on more debt to spend, right? So it's not all doom and gloom. So the used vehicle value basically is dropping, right? So this has been a predictor for inflation as well, right? So when 2020 or 2021, somewhat there, so this was the first indicator that basically people pointed to that predicted inflation, which was correct, right? So let's see if dropping car prices, used car prices, will lead towards us having lower inflation in the US, and therefore the Federal Reserve will have to hike less aggressively, right? So if you're enjoying the video so far, do help me smash up the like button, hit subscribe, and also hit the bell button and press on all, right? So this will really help out the channel, and also watch till the end, right? Because obviously you don't want to miss any important information. So it's not all bad news. So the last thing I want to talk about is basically I'm using these FANG companies as an example, but obviously you don't have to buy all these companies, right? I'm just using it as an example. So companies with strong moats and also strong cash flow, no debt, or low debt, or ability to sustain the debt, right, will also do well through this recession, right? But because you have to remember that the weak companies will basically be weeded out. So all the weak companies will be weeded out, but the earnings of these companies will also go down along with it, right? So I don't think that there is any company out there that is immune to a recession, right? So some people will say, oh, recession still can outgrow it. Of course, if you're looking at maybe a smaller company, maybe recessions don't affect them as much, right? Because if you are, like, let's say a new software company growing at 100%, so if there's a recession, you grow at 90%, it won't hurt you as much as it hurts all these mature companies that are relying on all the cash flows that are already currently present, right? So if I just had to draw a picture, right? So this maybe is a normal economy. This is a recession, right? So what happens when there's a recession? Obviously, the price to earnings ratio of these companies, right? Let's say people are only willing to pay a price to earnings ratio of 10, right? But this price to earnings, obviously the price is one thing and the earnings is another thing, right? So if you are paying, let's say 10, this is 10, and the price is basically 100, right? So because 10 times price to earnings, the earnings is 10, right? But if you are paying 5, then it becomes 50, right? And what will end up likely happening somewhere around here or somewhere around here is that earnings and price multiples are both very compressed, right? Because we can see that even Facebook is trading at a 14 times forward price to earnings ratio, right? So what happens is, let's say it trades at a 10 times price to earnings ratio, but both the earnings and the price multiples are very depressed, right? And that is the time that we will be looking to buy stocks, right? And I think only in a recession we'll get this kind of opportunities, because in normal times the earnings will be good, therefore the multiples will be good, and also due to the growth being high, so obviously people assign higher and higher multiples if there's higher growth, right? So in normal times we won't be able to see this. So what you would want to look out for is, you want to look out for companies that have the ability to grow much more in the future, right? But they are being priced like, for example, a good example would be Palantir, right? So currently they are projecting to grow 30% for the next 5 years. During, I think that was during 2021 or something like that. So they say until 2025 they'll grow 30%, but at the current clip they are only growing around 20 something percent, right? So if they are able to hit their growth rates, right, it'll be something like this, right? So this is the 20% marker, right? So maybe here is the 20% marker, and then maybe they'll even go lower. This is maybe 15%, right? So if they are able to actually hit those numbers, right, if those numbers are just temporarily being erased, right? Because the stock market only looks forward maybe 6 months to 12 months, right? So some people will think that this is permanent, right? Especially when it's going down like this, that this is permanent, right? Which I don't think so, because some companies have basically their growth lowered down, but after that they continue growing, right? So that is just some of my thoughts of when the best time to buy stocks are. And I think we're approaching that time, right? And I think the market will give us opportunities to buy cheap, basically. So what is my conclusion? My conclusion is that in this 2-3 months, I think there will be a November-December rally, because earnings are not going to be as bad as people expect, because maybe people expected the bad earnings to come in too fast, right? But if this rally happens and people expect higher earnings, next earnings, I think they're going to be sorely mistaken. So the earnings recession will have to come, right? Because if you think of it properly, how does inflation go down? Spending has to either go down or supplies have to go up, right? So we are currently seeing the Federal Reserve trying to weaken demand, right? So if there's no weaker demand, so either supply has to step up or demand has to go down, right? So obviously right now, I think there is excess demand, right? So that's why the Federal Reserve is also trying to cull down the demand, right? And also there is only so much unnecessary stuff we can buy, right? Because like Nvidia chips or whatever it is, how many people actually need a 4090? But if people have money, they'll buy it, right? So which will lead to more inflation. So I do want to say one thing before I end the video, because what I talk about in this video are all very complex things, right? So I don't think people should incorporate too much of this into their investing as well, right? Because maybe I might be blinded by the noise, right? Maybe all these surveys and all are just noise, but I don't realize it, right? So I think the best strategy for people who are not spending so much time researching, and also maybe the simpler strategy will just to dollar cost average into strong companies. Obviously, if you cannot pick out the strong companies, just dollar cost average into the S&P 500. So obviously, this is not financial advice, right? But I do think that sometimes simplifying investing and doing less is also doing more for your returns, right? So just wanted to leave that note there in case this video is maybe a bit too confusing for some people. I'm like talking about this is so many factors and reflexivity and stuff like that, right? So just want to leave with that note. So this is just my outlook, right? So no matter what happens, I'll be okay. So I think that is the most important thing when it comes to investing, right? So you have to put yourself in a position where no matter what happens, the market goes up, down, sideways, you're okay, right? So that's about all I wanted to share today. If you did enjoy the video, do help me smash up the like button, hit subscribe, and also hit the bell button, and comment below, right? What do you think? Are we going to hit the earnings recession, or can we even potentially avoid the earnings recession? That is also a potential scenario, right? So with that being said, have a fantastic day ahead, and peace out.